Welcome to This Explainer. Look, getting ready to buy a home is absolutely thrilling, right? You're hitting those open houses, mentally placing your furniture in the living room, dreaming of fresh paint. It's a great feeling. But before you even think about putting pen to paper and submitting an offer, we need to talk about your ultimate financial shield, the Illinois Mortgage Calculator. We're going to see exactly why crunching the math before you make a purchase isn't just a good idea, it's literally the single most important step you can take to protect your financial future.
Okay, let's dive into this. Here's the 5-step path we're taking today. We'll start with the homebuyer's reality check. Then we'll break down the payment, look at the variables that change everything, uncover the hidden costs of homeownership, and finally, give you a solid pre-purchase action plan.
Section 1. The Homebuyer's Reality Check. Time to confront the biggest pitfall in real estate. It is so incredibly easy to fall head over heels in love with a property while remaining completely, totally naive about what it actually costs to live there. So you really have to ask yourself honestly, does your dream home actually fit your monthly budget? Listen, a mortgage is far, far more than just dividing the sticker price by 360 months. If you go into the Illinois housing market assuming that simple math is all it takes, well, you're setting yourself up for a massive financial shock. A good mortgage calculator forces you to answer this question with hard data before you get emotionally attached to a house that's secretly going to bleed you dry. Section 2. Breaking down the payment. Let's unpack the hidden mathematical reality of what you're actually paying for. When you make that mortgage payment every single month, your money isn't just going into one bucket. It's actually splitting into 4 distinct directions. In the lending industry, this whole package is known as your PITI. First up, you have the principal, which is the actual repayment of the core loan balance you borrowed. Next is the interest, right? That's simply the cost of borrowing those funds from the bank. But then we have the final 2 pieces of the pie, and these are the ones that constantly catch first-time buyers off guard: taxes and insurance. We're talking about your local property tax obligations and your homeowner's insurance premiums. Typically, your lender holds this money in what's called an escrow account and pays those local bills for you when they're due. So a good calculator doesn't just figure out your loan, it estimates this entire 4-part breakdown.
But hold on, because there might actually be a 5th piece of the pie for some of you. Enter private mortgage insurance, or PMI. If you put down less than 20% on your home, you are almost certainly going to get hit with this extra hidden layer of cost. PMI is insurance that protects the lender, not you, the lender, if you happen to default on the loan. It generally runs you somewhere between 0.46% and 1.50% of your total loan amount, and that's every single year. Now, while PMI does let you get into a home sooner without a massive chunk of cash up front, it heavily impacts your monthly obligation. You'll be stuck paying this extra fee every month until you finally hit that magical 20% equity mark.
Section 3. Variables that change everything. Welcome to your financial sandbox. And this brilliantly illustrates the real power of running the numbers. I want you to think of the calculator as a financial sandbox where you can pull different levers. Look at how tweaking just the down payment changes the entire game. Say you're looking at a $300,000 home and you put 10% down. Your estimated payment is around $1,850, a moderate impact, right? But if you bump that down payment up to 20%, your payment drops to $1,620. That saves you a ton in interest over time. Now scale it up to a $400,000 home. A 10% down payment means a pretty hefty $2,460 a month, which is a really high commitment. Pushing that to 20% brings it down to $2,150, putting you in a much more balanced, comfortable position. This right here is the massive aha moment. Playing with these numbers shows you exactly how your down payment dictates not just your long-term affordability, but your daily stress levels. Another massive variable you have to consider is the type of rate you choose. On one side, we have fixed-rate mortgages. These give you a locked-in rate for the entire life of the loan. The beauty here is absolute stability and predictability. Your principal and interest payments will literally never change, which perfectly shields you from any future market chaos. But on the other side, we have adjustable-rate mortgages, or ARMs. These try to entice you with a lower initial rate for a set period, maybe 5 or 7 years. But you have to be incredibly careful here. Once that introductory honeymoon period ends, your payments can increase significantly depending on what the broader market is doing. It requires very careful, proactive financial planning.
Now, let's talk about the duration of the loan, because this forces a pretty major choice. A traditional 30-year term spreads your debt out over 360 months. This gives you smaller, much easier monthly payments, instantly affording you a lot more breathing room in your current budget. A 15-year term, however, is a whole different beast.
You are going to have substantially higher monthly payments right now, today, but you will pay significantly less total interest over the life of the loan. Basically, you're deciding between paying less today to free up cash flow or saving much, much more tomorrow. The calculator lets you test out both scenarios to see exactly what your current income can comfortably handle.
Section 4, Hidden Costs of Homeownership. Let's pump the brakes and go way beyond the basic math. You always have to contrast a neat, tidy calculator estimate against the messy, actual reality of owning a house. Your principal and interest? Yeah, those are fixed and standard. But look at property taxes. A basic online calculator might throw out some generic national estimate, but we're talking about Illinois here, where property taxes vary wildly from one county to the next. Your insurance is also highly policy dependent, based on the specific risks of the property you buy. And notice that maintenance category? Basic calculators completely ignore it. But I promise you, when your furnace inevitably dies in the dead middle of a freezing Chicago winter, that expense is extremely real. Emergency repairs, a new roof, these are variable, unavoidable realities of homeownership that you absolutely must budget for on top of your calculated monthly payment. Beyond the loan itself, there are a few other key factors that can completely alter your baseline math. For starters, your credit score has a massive, high impact on the interest rate you'll actually be offered. Property taxes, like we just said, have a medium impact purely based on where you choose to live. And whatever you do, definitely don't forget about HOA fees. If you are buying a condo or moving into a managed community, homeowners association fees can add a low to medium impact to your monthly costs, and that is totally independent of your mortgage payment. This brings us to a vital truth in real estate. A strong credit profile is the absolute foundation of affordable homeownership. It's what actually grants you access to the most competitive financing terms available in the market. Your personal financial health is the ultimate key here. You can play with a digital calculator all day long, but to actually unlock those lower monthly payments in the real world, lenders need to see a credit profile that proves to them you are a low-risk investment.
Section 5, your pre-purchase action plan. Let's take all this knowledge and turn it into concrete action. So the crucial point is this specific, very important number right here, 28%. Lenders strongly suggest following what they call the 28-36 rule. For our purposes right now, I just want you to focus on the 28. This rule dictates that your total housing costs, meaning your full PITI payment we talked about earlier, should absolutely never exceed 28% of your gross monthly income. This is your anchor. When you're using the calculator, if the monthly payment starts pushing past 28% of what you earn before taxes, you need to back away because you are putting your financial stability at serious risk. All right, here is how you practically use this digital tool to transform abstract math into a safe, verified budget. Step 1. Just make sure your browser is ready to go, JavaScript is on, and locate those main input fields. Step 2. Enter highly accurate home price and down payment data. Seriously, don't just guess here. Use realistic numbers for the actual market you are shopping in. Step 3. Toggle those loan terms. Switch between 15 and 30 years, adjust the interest rates up and down a bit, and review the different monthly estimates to find that perfect sweet spot that keeps you safely under that 28% threshold. Now, what's really interesting about this next phase is where the rubber meets the road. As industry experts constantly note, getting pre-approved is the single most important step in the home buying process because it turns your hypothetical budget into a verified offer. Look, the online calculator is your sandbox. It's step 1, but a lender's formal pre-approval is what makes your mathematical planning a reality in the market. It confirms your actual interest rate, it sets your true borrowing limit, and it proves to sellers that your financial planning is fully backed by a bank. We've covered the hidden costs, the moving variables, and the exact steps you need to take to shield your finances. Which leaves us with one final, incredibly important question. Are you going to calculate your exact financial reality before you fall in love with your next home? The tools are right there, literally at your fingertips. Please, do not let emotion drive the biggest financial decision of your life. Run the numbers, know your limits, and buy your next home with absolute confidence.